to be a part of this esteemed organization, which is nowadays not only acclaimed in India, but in abroad also. Taxmann has almost become a popular name across the world. So without wasting much time, it is 5:05. We would be stretching the session by 6 o'clock, and then we would be taking up hurriedly all the questions. But you are still welcome to post your questions as and when it comes into your mind. But I'm hopeful the issues which we would be taking up during the discussion would at the same time answering your questions also. So just let me share my PPT. Yes, it is there. Yeah. So my learned participants, I am just creating a preamble of the session. What is at all the need of the discussion on the topic of valuation? Why not any value which a businessman wants to supply his goods or services is acceptable to the department? And since there is a big question and big reason for the same, that's the reason there are provisions under the statute along with various rules and various circulars and various judicial authorities which we may be taking up within this short span of 60 minutes. You see, supply without consideration versus free supply. Most of the time, it is considered as a synonymous term. That if a supply is sent without consideration and if it is a free supply, these two terminologies are one and the same thing. But under the law, there is a big difference between the two. Let me give one example. That suppose a pharma company is supplying its medicines to the doctors, distributors, etc. as samples which are without consideration. Those supplies are taxable under the GST law. Whereas once the same pharma company puts those medicines at Kumbh Ka Mela for the public at large to come forward and pick up the medicines to the consultant sitting there, those free supplies are not taxable under the GST law because they goes outside the purview of the definition of supply without consideration, because consideration is one of the mandatory condition before a supply becomes part of the statute. Another example, there is a restaurant supplying food on voluntary payment basis. Means thereby you just go into the restaurant, eat food, and while coming out, it's your choice whether to pay money or not. So in those situations, whether the money received voluntarily by the restaurant is taxable under the GST law or not, the answer is yes. Neha Kakkad, Arijit Singh singing and public making voluntary payments, whether it is taxable, answer is yes. Beggar on the street singing a song and getting money, whether this money is taxable under GST, answer is no. There is a building in Birla Kurla complex or Cannot Place wherein the cost of land is 80% and the construction cost is 20%, whether the taxpayer can go splitting this land and building and can pay tax on only 20% of the portion which is the construction cost, answer is no. EPC projects like solar panel, we know that solar panels are taxable at the rate of 5%, whereas the works contract is taxable at the rate of 18%. So in case there is an EPC project of installation of a solar project, whether that in totality would be taxable at the rate of 18% or it can be splitted into two parts. That is, one is supply of solar panel being taxable at the rate of 5% and rest of the project is taxable at the rate of 18%, which may be 5 to 10% part only. The answer is yes, because the government has issued a clarification or circular on this aspect, mitigating the hardship of the taxpayers. Otherwise, this would have been taxable entire project at the rate of 18%. That's the reason there is a need for provisions relating to valuation under the statute. Another example is whether two brothers, when transacting with each other, whether they are relatives, answer is no, because the explanation appended below section 15, which is defining who is relative, in that particular definition, brother and brother are outside the purview of related parties. So there is a need of defining who is relative and who is not relative. The definition contained under the GST law is unlike the definition given under the corporate law or the income tax law, because this law is peculiar in itself, unlike those other two statutes. Then there is another example, whether a food industry like Haldiram is manufacturing food, say in Haryana, but its restaurants are pervasive in the state of Delhi. So whether the food supplied by a Haryana factory to the restaurants in Delhi would be free from any valuation provisions, answer is no. Otherwise, the food industry will under invoice its supplies from factory to restaurant, because restaurant would be charging at the rate of 5% without claim of ITC. So there would be a scope of tax planning under the situation. So therefore, there is a necessity that in case the transaction is between the related parties, still the supplier will not be free from supplying at any price he likes, in spite of the fact that there is a second proviso to Rule 28, which gives leverage to the supplier in such situations to supply its supply at any price he likes. That is on the transaction value. But in spite of that proviso, we are of the opinion, because of certain other regions being contained under the law, that such supplies cannot be made at any price the supplier is interested to do to mitigate his tax liabilities. So these are the preamble questions only, which I have just stated the question and answered in short. So hope you understood the necessity of discussion on the topic and necessity of enacting such provisions into the law, why Revenue Department or the Parliament is containing certain provisions which in day-to-day life are difficult to follow by the taxpayers and difficult to understand also. So it is because of the reason, because the taxpayers are smart enough to cover up their tax liabilities by putting different values to different transactions. So that's the reason there is a necessity of the today's topic. So this is only a preamble slide. Now we are entering into the provisions of law, which we are going to discuss today. Section 15 contains 5 subsections. And this is the only section, very small sections. It may contain within 1 page of the statute book. This is the only section which is containing the provisions relating to value of taxable supply. But so there are certain rules which are being appended, annexed, attached with this particular section. They are like this, that Rule 27 will talk about consideration is not wholly in money. Means in cases where there is a consideration which flows into money as well as in non-monetary terms also. In those particular situations, the valuation provisions would be followed in terms of the provisions contained under Rule 27. Now, Rule 28 will talk about supply to related persons, not agents. So whenever any supplier and recipient are into a related party definition, in that particular case, Rule 28 would be applicable for the purposes of taking care of proper valuation provisions or not. Then Rule 28 will talk specifically of transactions between principal and agent. Rule 30 will talk about value of supply at cost. Rule 31 will speak about a residual method when Rule 27, 28, 29, and 30 fails. Then Rule 31 will come in picture. Rule 31 capital A will talk about the provisions relating to valuation in case of lottery and betting. Rule 32 will talk about supplies made to travel agents, and then Rule 32A will talk about Kerala food cess cases. Rule 33 talks about pure agent services. Rule 34 talks about currency exchanges, and Rule 35 will talk about value inclusive of tax. So these are the broader provisions of law, means Section 15 read with Rule 27 to Rule 35 will speak about the total valuation provisions being contained under the GST law. Now, there is a very important discussion we will take place. From here, we are starting our today's discussion. Principle of quid pro quo. My learned friends, any indirect tax law, come what may, it is central excise, it is service tax, it is VAT, or it is GST. The levy triggers through the terms of the contract. Contract may be oral, it may be through a purchase order, or it may be a written contract. And this contract is being regulated under the provisions of Contract Act 1872. And valuation provision is the study of all contractual obligations. Whenever there is a contract, now there is a proposer, then there is an acceptor, there is a consideration, there is a legality of the contract. All those ingredients which we studied under the Contract Act 1872 should be present into a contract. So whenever there is a contract, on what may it is oral or written, the provisions of valuation is a study of all those contractual obligations which can impact the value of a transaction. So there can be large number of ingredients of a particular contract, and the value or consideration may be split into different names or different segments and different timelines. Like continuous contract of a works contract may span over 3 years or 5 years period as well. So the first principle which we have to understand is the principle of quid pro quo. Like in the preamble slide, we took example of Neha Kakkad and Arijit Singh. Although in a mall, they are singing voluntarily and they are not asking for any money from the audience, but still I replied that if audience is making payment to them, it is taxable under GST in spite of the fact that there is no quid pro quo principle applicable there. Although here I am telling that principle of quid pro quo is necessary to make any contract valid. Why I am saying so? That in this particular case, there is an oral agreement or hidden agreement that once Neha Kakkad and Arijit Singh will reach to a mall, say in BKC or Connaught Place, and there would be a large public, and once they would be singing, so public at large would be throwing money onto them. Once they will make a voluntarily call that whomsoever wish to pay, they can make a UPI payment or bank transfer, etc. So even if they are asking for voluntary payment from the public at large, that the quid pro quo principle would stand existing there silently. But in case of a beggar who is singing on a street and public are still making payment to him, those are not having quid-pro-quo principle, and it is a unilateral act on the part of the beggar, and whatever money he is receiving in the absence of quid-pro-quo principle, it is outside the purview of supply. Therefore, it is not taxable under the GST law. This is the significance of quid-pro-quo principle. Then we are entering now section 15 and its study. In brief, we will talk about section 15.1. This is the essence of valuation provision, means this is the main provision which I can say is the sole provision, sole subsection into the law which regulate 90% of the transaction into the whole industry. It says the value of supply shall be transaction value. Now this transaction value over a period of time from the era of erstwhile laws has saturated, and it becomes a word in common parlance. The transaction value means arm's length price, which normally a taxpayer charges from a unknown party who is not related, and from whom he is receiving the consideration in terms of money. So fulfilling these two conditions, that he is not a related party and price is the sole consideration for supply, means he is getting the consideration only in terms of money. If these two conditions are being fulfilled, then the lawmaker says we will accept the transaction value as a fair price or valuation for the purpose of charging GST. This is being contained under section 15 subsection 1. There are two more subsections which we will discuss. Section 15.2 will talk about then what is still to be included or can be included into this transaction value, and what can be excluded is contained under section 15.3 from this transaction value, because the consideration from the recipient can flow at different occasions and in different names. So if I am selling a product, then I can charge separately for packaging, I can charge separately for freight and cartage, I can separately charge for insurance, I can separately charge for selling commission, I can separately charge for many other names. All those we will discuss here. So section 15.1, 2 and 3. These three subsections in totality will contain provisions relating to what is the ingredients to be included and excluded into the transaction value. So in the earlier slide, we were talking about sole consideration. So sole consideration and consideration, what is the difference between the two? The definition of transaction value talks about this sole consideration word. Now, money is the sole consideration that this particular definition says. So definition and the law expects that the recipient should pay to the supplier in terms of money only, but there can be non-monetary terms also, wherein the consideration can be paid otherwise than in money also. There can be some barter, there can be some exchange, or there can be some exchange of services, etc. Like there is a doctor and I am a supplier of say refrigerator. I can supply a refrigerator to him and he can supply his consultancy to me. So there can be consideration besides money in any form. Then consideration, the word is definitely described under section 231, wherein it is stated that the consideration may flow even from a third party, or it may be in the form of some tangible or non-tangible, monetary and non-monetary terms, etc. Then this is a very significant slide. Here you should focus understanding this particular slide, and I hope this will clarify your loads of doubts. There are a few questions. I will be taking them in the last. Absence of consideration versus presence of non-monetary consideration. I'll read it again. Absence of consideration versus presence of non-monetary consideration. These two words looks to be a little confusing. There is an absence of consideration, means there is no consideration. Normally, the example of absence of consideration can be that I supply things free of cost. Like I'm a contractor, I'm a original equipment manufacturer, and I'm supplying mold and dies. Then presence of non-monetary consideration. While I am supplying free of cost, there is a possibility that there is a presence of non-monetary consideration. And this is how tax planning can happen. So we are talking about this particular aspect in this particular slide, and the question answers there under. There is a circular number 47 issued by the CBIC, which talks about a situation that when mold and dies are being supplied by the OEM, original equipment manufacturer, say Maruti, free of cost to its equipment manufacturers. So whether those supplies will impact the valuation between the OEM and the component manufacturer, and the answer is depends upon the terms of agreement. Now let us see what are the possible terms of agreement. Situation A. Mold and dies owned by OEM, say Maruti. Maruti is the owner, original equipment manufacturer is the owner of mold and dies. They are being sent free of cost basis to component manufacturer, say KK Industries. And it was the obligation of the OEM to provide mold and dies to the manufacturer. So while they entered into an agreement of pricing of supply of the equipments from the manufacturer to the OEM, suppose the price was fixed at rupees 100 rupee per piece. And within that agreement, it was written that the mold and dies would be supplied by the OEM. Then question 1, whether such supply in the hands of OEM is taxable. Whether such supply means when mold and dies are being supplied to the component manufacturer. And the answer is no, since there is no consideration. Since the mold and dies were being supplied free of consideration, without consideration. Whether ITC in the hands of OEM to be reversed, once again answer is no, since it is used for the purposes of business and in furtherance of the business. Question 3 is whether it will impact the valuation of supply made by the manufacturer to the OEM. Once again answer is no, since it was the obligation of the OEM to provide the mold and dies. So these are the prominently 3 questions. One in the hand of the OEM, once mold and dies are being supplied, whether they are taxable. Considering, say, schedule 1, answer is no. Then second is whether ITC on mold and dies are being allowed, answer is reverse, answer is no. And whether it will impact the pricing between the manufacturer, and all the three questions are in negative. But once the situation changes, that now it is not the obligation of the OEM to provide mold and dies to the manufacturer, and he still provides mold and dies to the manufacturer, then what happens? Whether it will impact the valuation of supply made by the manufacturer to the OEM? Answer is yes. The amortized value of the mold and dies are to be added into the value. So if he is supplying such manufactured goods to the OEM at the rate of ₹100, the amortized value of these mold and dies, say ₹10, would be added into this valuation, and then levy of taxes will take place. Next question is whether ITC in the hands of OEM is to be reversed. Answer is yes. Since it is not used for the purpose of furtherance of business, because of the reason that it was the obligation of the manufacturer to purchase his own mold and dies, but OEM is supplying these particular mold and dies to the manufacturer. Since it was not his obligation and he is still supplying, therefore it will tantamount as if he has given a free gift to the other person, and ITC would be subject to reversal. Then we are entering now into section 15.2. Section 15.2 will talk about situations what are to be included or added into the transaction value, which I talked earlier. So in pictorial format, you will find, I had to catch hold of the time because time is very short. Any taxes, duties, cesses, fees, charges other than GST law, if these are being paid into this particular transaction, I'll give you certain examples also. Then amount incurred by the recipient for which supplier is liable. Then incidental expenses including commission and packaging. Then interest or late fee or penalty, and then subsidy other than received from the government. So these are the ingredients which will still be added into the transaction value, and then only we will compute the tax liability. Now let us understand them with some examples. Any taxes, duties, cesses, fees and charges levied under any statute other than GST law, like any municipal taxes not subsumed into GST, excise duty on tobacco, passenger service fee and user development fee. Suppose there is a ticket from the airport, from some aviation company we purchased, you will find such kinds of details which are being added into the basic fare, and then there is a computation of GST. Similarly, tobacco is subject to dual levy, and once there is a transaction value, say ₹1,000, then first central excise would be added and then GST would be computed. So all other taxes to be included when we compute GST other than the GST laws. Then any amount that the supplier is liable to. I'll give you some examples. In relation to such supply, but which has been incurred by the recipient of the supply and not included into the price actually paid for the goods or services, like damage charges paid by the purchaser on behalf of supplier and freight insurance paid by the purchaser in case of CIF supply. Now let me give one example. Suppose I received certain goods from Mumbai at Delhi, and goods are lying into the godown of a railway station. Now it is the obligation of the supplier to give the delivery of the goods at my factory in Delhi, but he is requesting me that there are some damage charges on those goods, say 10,000 against the total value of 1 lakh of goods. So he requested me to pay, although he was liable to pay any amount that the supplier is liable to pay, but I am paying them. So what I did, I asked him to raise me an invoice of 90,000 and I paid demurrage charges of 10,000, and then I discharged my liability of taxes on 90,000. He might have issued me a credit note, or he might have issued me a revised invoice, whatever way he made the adjustment. Same way, freight insurance, etc. So in case transaction value is being decided, and it is the obligation of the supplier to incur these expenses also before the delivery is being handed over to the recipient. In that particular situation, all those particular expenditures before the delivery takes place are to be forming part of the transaction value and would be liable to GST. Then I am coming to now section 15(2)(c), that is incidental expenses. Earlier I talked about A, taxes, then I talked about B, wherein the obligation was of the supplier but the recipient paid. Now C, incidental expenses. Now incidental expenses can be many, like incidental expenses including commission, packaging, charged by the supplier to the recipient of supply, and any amount charged for anything done by the supplier in respect of supply at the time of or before delivery of goods or supply of services. Means besides the taxes or besides any other expense, there can be so many incidental expenses which can take place before the final delivery of the product. Those will also form part of the transaction value and would be subject to levy of GST. The examples can be car seller providing services like number plate, registration, handling charges, etc. before the delivery of the car, packing charges, commission, freight, insurance, handling charges like loading, unloading, demurrage charges, C&F expenses, bailment charges, local levies like municipal taxes, etc., home delivery charges of food, if any, packing charges of a showpiece at a gift shop. So all these expenses, if are incurred by the supplier before the delivery takes place, then these will form part of the transaction value. Now we will talk about hurriedly about the deductions. Transaction value not to include any discount. Now the discount can be of two types. The value of supply shall not include any discount which is given before or at the time of supply if such discount has been duly recorded into the invoice. So before the delivery is taking place, and if this value, if the discount is being mentioned into the invoice, then it is allowed. But if the discount is being given after the supply, then fulfillment of two conditions are necessary before the deductions would take place. That such discount is established in terms of an agreement. Now, agreement can be oral or written, entered into at the time or before the time of supply, specifically linked to relevant invoices, and input tax credit as is attributable to the discount on the basis of discount issued by the supplier has been reversed. Means thereby, if any discount to be given is predetermined, then the output tax liability of the supplier would be reduced. But at the same time, there is another condition that the input tax credit is to be reversed by the recipient. Now, we will talk about various kinds of discounts. In-bill discounts. Normally, it is allowed. In-bill discounts means the discount which we talked just now, that it should be mentioned into the invoice. Then off-bill discounts. Off-bill discounts are normally given through credit notes, and section 53 conditions must be fulfilled. Section 15(3) talks about those two conditions, that the discount should be subject to agreement, and second condition is that the recipient has reversed his input tax credit. Cash discount. GST outward reversal not allowed, because cash discount is not part of the price. It is part of the early making payment by the recipient. So it is just a monetary transaction. So it will not impact the outward supply or the inward supply, neither of the supplier nor by the recipient. Quantity discount is definitely allowed subject to fulfillment of condition of section 15(3). Aggressive discounts nowadays we are very much fond of getting from e-com companies, and sometimes they offer 90%, 80% discounts. So whether such aggressive discount is allowable under the GST law or not, there is a prominent decision in the case of Fiat India Limited of Supreme Court, wherein the Fiat company supplied cars at a discount, and the issue arose whether the central excise would be leviable on the total price or on the discounted price. And the matter was decided in favor of the revenue, that the total value of the Fiat car would be subject to taxation, because of the reason the hefty discount offered by the Fiat India Limited was in lieu of the advertisement expenditures not to be incurred, but the discount in pricing is to be offered to the customers at large. So they offered heavy discount to early bird customers, and the authorities, when intervened, even up to Supreme Court, the supplier could not win the case, and he lost, and he had to discharge tax liability on the higher amount. So this is the position of aggressive discounting. They must fulfill the provisions of law, only then it would tantamount to have been fulfilled and reduction would be given, else they would be liable for taxation. Reverse supplies. Supply of services with the dealer to the manufacturer. These reverse supplies are very much prominent nowadays. Suppose there is a manufacturer of building materials, say, sitting in the state of Delhi, and across India he is having dealers. Now those dealers are promoting his business, marketing his business into their regions by having dealers meetings, by putting hoardings, or by creating some business meetings, or by conversing the public at large through various media, etc., maybe social media or by any other mean. And then they are claiming that money from the principal sitting in Delhi. So in fact, those dealers are now into a reverse relationship with the manufacturer, that they are providing marketing services to the principal. And principal company is expected to pay their reimbursements. But those reimbursements, whether can be raised on simple letterhead or they should be raised through proper tax invoices. So the answer here is that since the dealers are providing reverse services to the principal company, therefore such transactions should flow only in terms of tax invoices, and they are subject to levy of GST. Discount in kind. Discount in kind takes place like the company is giving holiday package to the dealers or distributors who are achieving a particular target. They are offering gold coins, they are offering motor vehicles, any kind of lure when the companies are making to their dealers after having achieved a certain turnover, then it is very difficult to fulfill 15(3) conditions, because section 15(3) talks about two situations. One is that there should be a pre-agreement, and then there should be a credit note, and then there should be a reversal of input tax credit. So 15(3) conditions are difficult to maintain in these particular situations. Therefore, it becomes quite difficult to consider this to be a discount. Then if it is not discount, then what should be the treatment? So I am putting in an example to make you understand how we can deal with such kinds of offers by the companies at large nowadays. Like holiday package, I'm taking an example. Holiday package by manufacturer to a dealer. Option 1, there is a travel agent. Travel agent is billing to the manufacturer. Manufacturer is further giving this package to its dealer. Now what will happen? That manufacturer is transferring the business assets, that is this travel package, in terms of para 4A of schedule 2 to the dealer. So this particular transaction would be taxable in the hands of the manufacturer while he is transferring this package to the dealer. At the same time, when travel agent is throwing this package to the manufacturer, he will charge input tax credit, and at the same price, he will transfer it to the dealer. In that particular situation, it would be a revenue neutral transaction, and it can happen both in case of holiday packages or any item like gold coin or motor vehicle is being transferred from a manufacturer to the principal and then to the dealer. So while the principal will purchase the motor car, he may claim input tax credit, and at the same time he may discharge tax liability while the car is being given away to the dealer. But it depends on each fact and circumstances of each case how such transactions should be dealt with. This is in a common parlance. I have cited one example. Now there can be one more option. The travel agent is billing directly to the dealer, and payment is being made by the manufacturer. This is also a model available into the field. But so this kind of transactions will fall back at point number 6, wherein I talked about the reverse supply, means supply provided by the dealer to the manufacturer. So in that particular case, the dealer will bill to the manufacturer for providing services, and then the reimbursement will take place. Means this transaction would be utilized from the side of the dealer to the manufacturer. Then free stocks, similar to discount in kind. These free supplies are not only taxable in the hands of manufacturer, but ITC is also not available to the dealers. So it is not tax, it is tax inefficient transaction. So whenever a particular dealer has achieved the target of say 1,000 items, he would be given away 10 items free. So that free will on the one side would be taxable in the hands of the company, and at the same time ITC will not be allowed. Taxable would be under schedule 1 and ITC would be reversed under section 17(5). So that's the reason these free stocks distribution we normally discourage into the field. Buy one, take two. Once again, free stock distribution. It is not the case where 2 units of stocks are bundled together with a single price assigned to them. Therefore, unless bundled together, as example, 4 bars of stock with pre-selected unit of stock and a single price affixed, all other transactions of buy one, take two are individually taxable. The said unit at the price paid and the free unit at the price determined by the valuation rules. Means these kinds of transactions would remain tax inefficient unless they are bundled together and billed accordingly. I mean to say that if I want to sell one shirt and one I want to give away free, then what should I do? I should create this logo or scheme outside my showroom, but while billing, I should bill these 2 shirts as if both are taxable, but at the price of one. This is how field formations are already doing. Cashback coupons in product packaging. The product being supplied to a customer contains a cashback coupons. It will not reduce the output tax liability. Cashback may represent the marketing expenses, and cashback coupons provided by other than supplier, like benefits given by e-com operators. So these are only marketing expenses of the e-com operators. Gift vouchers valid for subsequent supplies. The customer is given credit points to avail on subsequent purchases, subsequent sales, value can be reduced. This normally it happens this way, and there is no objection to the lawmakers as far as the benefit of such vouchers is being given to the customers while they make subsequent purchases. Free ancillary articles like free bag with laptop, no tax on bag, no ITC reversal, these are only marketing expenses. So any company is free to distribute diaries or their t-shirts or caps or tiffins or pencil box or pens or calendars or whatever way they want to promote their business by putting their logo, putting their name, putting their advertisement, etc. on that. And if such things are not a matter of tax planning, these are the expenditures of business promotion. ITC is allowed at the time of purchase of these items, and at the time of distribution, there is no tax liability. Nominal value supplies. The value as per Rule 27. Second proviso to Rule 28 may fail while passing through the test of sole consideration. Normally, in the field, there is a huge contest amongst experts that while there is a second proviso to Rule 28, why a related party cannot supply its supplies at any price he likes, subject to the condition that the recipient is eligible for ITC, because that is the condition being given into the proviso itself. But we, a school of experts, are of the opinion that this kind of planning is not free from doubt, because Rule 28 is not starting with a non-obstantly clause. And at the same time, there is Rule 27, which talks about consideration flowing in a non-monetary terms. So I mean to say Rule 27 and Rule 28, they are conflicting in nature, but at the same time, they are conflicting with the provisions of law also. When there is Section 7.1, read with Schedule 1, so that particular Schedule 1 talks about related parties. So in that particular case, if I would already be falling into the statute, the rules would be taken care of next. So rules cannot prevail the statute. So therefore, we are of the opinion that rarely we should try to avail the benefit of second proviso to 28. Now, very prominent, very beneficial, very controversial, I am taking this liquidated damages aspect before I conclude my discussion, and then I will be taking your question and answers. Circular number 178 dated 3 August 22 is there. It is in favor of the taxpayers. At most occasions, we unnecessarily pay taxes on so many kinds of liquidated damages, which we are not supposed to pay. Normally, the companies say just to buy peace, we want to pay taxes, but that's not the right. And in many litigations, whenever there is a liquidated damages, they are being held taxable by the authorities. But this circular is a mitigating circular. I would restrict myself to the contents of this circular for your better understanding. I will not travel to some judicial authorities and so, because time is very concise. So this particular liquidated damages concept, let me clarify that Section 7, read with para 5E of Schedule 2 has 3 limbs. One is agreeing to the obligation to refrain from an act like non-compete agreements. Builder refraining from constructing more than a certain number of floors. Now, why this builder is refraining from constructing more than certain number of floors? Because it is impacting the neighboring building. Suppose he is constructing 10 floors. The neighboring building may get impacted because it may not get sun now. So the neighboring building may ask that you may construct only 5 floors so that they may get proper air and sun. So in this particular case, the builder will refrain from constructing another 5 floors. For this reason, he may be paid certain consideration. So this is one wing of this particular aspect of liquidated damages. Then there can be second one, a shopkeeper allowing a hawker. It is tolerating an act. A shopkeeper allowing a hawker to operate from the common pavement in front of his shop against a monthly payment. Resident Welfare Association tolerating the use of loudspeakers by a school nearby. And then there can be a third wing of this is agreeing to the obligation to do an act like industrial unit agreeing to install equipment for zero emission discharge at the behest of the Resident Welfare Association, although legally it was not supposed to do so, but on the request of the RWA, the industrial unit has agreed to install the equipment. So these are the 3 situations where in the first one, there is a refrainment from an obligation. Then in the second one, there is a toleration of the act. And then in third one, it is obligation to do an act. Then let's create some examples. Liquidated damages paid for breach of a contract. Compensation given to previous allottees of coal blocks for cancellation of their licenses pursuant to Supreme Court order. You see, there was a fresh policy of the coal blocks to be allotted to the public at large. But what happened to the earlier allottees? The Supreme Court announced certain compensation to be paid to them. So whether that compensation is liable to tax under GST, those are the questions we would be dealing in while giving or citing these examples. Check dishonor penalty charged by a distribution company from the customer. Suppose there is an electricity company and your check is bounced and they charge ₹100 over it, whether this 100 is taxable or not. Penalty paid by a mining company to state government for unaccounted stock of riverbed. Somebody would have extracted, say, 10,000 square feet of riverbed, but he extracted 20,000, for which he paid some extra money. So whether this penalty is leviable to GST, this is the question. Now, bond amount recovered from an employee leaving before the agreed period. The late payment charge is collected by any service provider for late payment of bills. Then fixed charges collected by a electricity discount from the customer, etc. Then cancellation charges recovered by railway for cancellation of tickets. So what the education guide? Now let us understand the preamble of all these kinds of transactions, whether would be liable for GST or not. Majority of them are not taxable. That's the reason there is a point of discussion. Had there been everything would have been taxable, I would not have contained these in my discussion. Let me cite an example. Suppose I am constructing a building. I am a builder and I promised that I will construct this building within 2 years through a written agreement. There may or may not be any provision for liquidated damages if I will construct it late. I constructed it in 36 months instead of 24 months. And for constructing 1 year late, I paid ₹1 crore to the contractor. So whether this 1 crore is leviable to GST or not, answer is no. Reason being, Section 73 and 74 of the Contract Act 1872 triggers, and they allow the contractee to pay the legitimate liquidated charges. I'll discuss over all this. And Even if there is a stipulation into the agreement about payment of this 1 crore, whether it is there or not, still these liquidated expenses are not chargeable to tax. Then what is chargeable to tax and what is not chargeable to tax? If I want to distinguish that, let me cite you some more examples. Suppose there is a person who is a cab operator and he gave his cab for repairs to a workshop. And workshop person told him that he will charge 10,000 rupees to repair the car and he will deliver back the car in 2 days' time. But he delivered back in 10 days' time. And the cab operator lost, say, 5,000 in terms of his business. So whether this 5,000, which is called a damage or a liquidated damages, to be paid by the service station to the cab operator, is leviable to GST? Answer is no. But at the same time, suppose I am a telephone distribution company, I'm a communication company like Airtel, and I have customers at large, and I am giving leverage to my customers that if you will pay late, you will pay late charges. And I invoice them, say rupees 1,000, but the customer paid after 15 days, then he was bound to pay 1,200 rupees. So this 1,000 plus 200 is a composite supply and would be taxable at the same rate because there is a stipulation. It is not being regulated through the Contract Act. So any transaction of such movement of money or compensation or liquidity damages or penalty, etc., if they are being stipulated, whether into the agreement or not, but they are being regulated by the Indian Contract Act 1872 in terms of section 73 and 74, then they are not taxable. Else, every other transaction is taxable. So let us see what this circular says. The element of contractual relationship. I am talking of education guide in service tax law now. The element of contractual relationship where one supplies goods or services at the desire of another is an essential element of supply. Then, para 5E of Schedule 2 Act is strikingly similar to the definition of contract in the Contract Act 1872. A perusal of the entry at Serial 5E of Schedule 2 would reveal that it comprises the aforementioned 3 different sets of activities. Means obligation to refrain from an act, which I discussed, obligation to tolerate an act, and obligation to do an act. All the 3 activities must be under an agreement or a contract, whether express or implied, to fall within the ambit of the said entry. Then, agreement to do or refrain from an act should not be presumed to exist just because there is a flow of money from one party to another. Payment such as liquidity damages for breach of contract, penalties under the Mining Act, forfeiture of salary, penalty for check disorder. These are outside the purview of agreement. They are rather amounts recovered for not tolerating an act or situation and to deter such acts. Such amounts are for preventing breach of contract or non-performance and are thus mere events in a contract. They are not consideration, they are just events. Breach of or non-performance of contract by one party results in loss and damages to other party. Therefore, the law provides in section 73 of the Contract Act that when a contract has been broken, the party which suffers by such breach is entitled to receive from the other party compensation for any loss or damage caused to him by such breach. So it is not because of the agreement, it is because of the law of contract that the compensation is flowing from one party to another. The compensation is not by way of consideration. Now, section 74 further says that aggrieved party shall be entitled to receive reasonable compensation. And then it is argued that performance is the essence of a contract. Liquidated damages cannot be said to be a consideration received for tolerating the breach or non-performance of the contract. They are rather payments of not tolerating the breach of contract. Liquidated damages are a measure of loss and damage that the parties agree would arise due to breach of contract. And in case liquidated damages are merely a flow of money from the party who causes breach of contract to the party who suffers loss or damage due to such breach, such payments. Now I'm reading the language of the circular. CBIC says such payments do not constitute consideration for a supply and are not taxable. So this is how I have explained you the damages of a property, negligence, piracy, unauthorized use of trade name, copyright violation, penalty stipulated in a contract for delayed construction, forfeiture of earnest money, etc. in a real estate transaction. So all these are, although being called by different names and are liquidated damages, but are outside the purview of taxation of GST law, and in great majority of taxes, people are paying taxes on such transactions, or authorities are coming forward to discharge tax liabilities on such transactions. That's the reason there is a significance of this particular circular, and we must understand the contents of this circular. Read with section 7, schedule 1, schedule 2, and then section 73 and 74 of the Works Contract Act. Now, there are various kinds of discounts which I have just mentioned. I have just talked about those in various slides which are self-explanatory. You may go through them, which one is taxable and which one is not taxable, and the regions thereto, all the regions, etc., are being stated only through this particular circular, and you will certainly get enriched in your thought process about the idea of that such kinds of compensation, damage, penalty, liquidated damages, bond salary, notice salary, etc., whether they are leviable to GST or not. And with this, I close my discussion. Few of the slides would be self-explanatory, and with this, I conclude my discussion. I am thankful to you for patient hearing, giving me clearly 60 minutes. We started at 5:05 and we closed at 6:05. Now there are certain Q&A. Mr. Devendra is asking question, why sample to doctor is taxable, whereas Kumbh Ka Mela is exempt? My dear friend, whenever there is a non-monetary consideration in any supply, the lawmakers catch hold of it and they consider that to be a transaction between related parties, and they capture it within the ambit of non-monetary consideration, because the medicines which flows from company until doctor, they flow through distributors, etc. Those distributors are their taxable entities because of Schedule 1 relationship. They are related parties. So any supplies made without consideration, they are liable to tax. And once anything is given to the public at large, there is no motive except charity. So that's the reason there is a difference. Once again, Mr. Devendra is asking, last part, why fair market value is required. This is my suggestion. I told you that provision 2 of Rule 28 is conflicting with Rule 27. as well as section 7.1 as well as schedule 1. That's the reason we are of the opinion that you should always flow your supplies from one related party to another only through fair market value. Mr. Chirag Mehta. Kindly cover valuation in job work where scrap value is factored and is sold by job worker, or if sold on behalf of principal, then job work charge is affected or not. Kindly cover both scenarios if possible. Mr. Mehta, when a job worker is selling any scrap, it is under a contract between the principal and the job worker, and that contract itself takes care whether this scrap would be a consideration to be paid to the job worker or it is a supply to be made by the principal. So based on that particular contract, the taxability of this scrap will arise. MAIN, main. Under a sale scheme, on achieving target sales purpose, air conditioner is given free of cost. Whether ITC would be available on air conditioner. Under such situations, we advise that you should buy air conditioners and claim input tax credit, but at the same time, when you are distributing it to your dealers, after having achieved the target sales, you should discharge the outward tax liability also at the same price. Then it would be a revenue neutral transaction in the hands of the principal company. Mr. Sridharan, sir, when there is a donation of capital goods like used computers to related party where there is no consideration involved, still do we need to work out market value and pay GST? Yes, my dear, section 18, subsection 6 comes in picture here, which talks about that whatever input tax credit you have claimed and what is left out, and whatever is your transaction value in that particular transaction or arm's length price or open market value, etc. in that particular situation, please read out section 18.6 would be applicable in that particular situation. Any feedback form? I think this question is to the taxman, whether any feedback form is there. Hi, any participation certificate for today's session, sir? Once again, taxman will reply this question, whether there would be a certification. What is ITC on discount? That is to be reversed. You see, suppose you purchased goods worth ₹1 crore and worth 10 lakhs rupees, you received the credit notes. So to the extent of 10 lakhs rupees, you are supposed to reverse your input tax credit. Mr. Arun asked this question. Mr. Rajiv Kumar Nahata, while there is no GST on liquidity damages, would the same be subject to TDS under 196, 194C? You see, Mr. Rajiv, these two laws do not teach to each other. So you are independent to understand the significance of 194C. So being not an expert under income tax, I will not comment upon it. Ravinder Bhattji, in case of related party transactions, say from director to company, wherein let us say guarantee given to company for availing loan is deemed supply, and it is possible to argue the value is zero as the company can avail full input tax credit. Mr. Ravinder, certainly this is an area where there is a lot of litigation because there is no open market value, there is no like kind, etc. also. So in this particular case, your prudence would be should be accepted by both the departments. Proviso to Rule 28, Ravinderji, you are talking about. So proviso to Rule 28 is certainly applicable and you should take advantage of it. But where there are heavy stakes, we normally advise that you should at the same time look at Section 7 and read with Schedule 1 and read with section rule 27, because rule 28 is not starting with the non-obstantly clause. Notice period recovered from employees taxable under GST, no. Scrap sold by job worker can be deducted from job charges, depends on the terms of contract. Vinay Pandey is asking, my client is sending its product to influencers free of cost. My client is sending its product to influencers free of cost, and influencer is making reels for the clients. What will be the value of supply? You see, Mr. Vinay, in this particular situation, your client is using the product for its own purpose, because influencers are working on their behalf, on behalf of the company. They are promoting the company, they are creating advertisement to the company, they are making reels. That's the reason influencers or whatever being provided by the company is company's expenditure, and input tax credit would be allowed. Hiring vehicles with diesel. What should I do here? Hiring vehicles with diesel is taxable. Sir, how about the Mr. Sunil? I think you have not raised your question well. Please ask the question so that I can reply. Is a much better position. Krishna Rao KV, sir, how about the taxability of damage or dispatch money on high sea sale contract, which are agreed upon at the time of contract? Mr. Krishna, it depends on the terms of contract. What kind of damages you're talking about, and whether it is a late dispatch charges, or what are the damages, depend on the case to case, and if it is a part of the contract, it is taxable. At 90% discount of supply, will ITC be reversed? At 90% discount of supply, will ITC be reversed? Vinay, once again, this is very abstract question, so I will only say that if you received goods for rupees 1 crore and you received 10% discount, then on 10% ITC would be reversed, and this is irrespective of whether the supplier has reversed the output tax liability or not. Mr. Siddharth Sridharanji has extended thanks. Krishna Rauji is saying, sir, whether receivable amount written back is taxable. You see, receivable amount is something which you are supposed to receive against your supplies, and against your supplies you have already discharged your tax liability, because bad debts are not allowable. So therefore, receivable has nothing to do under GST and not impacting any tax liability. Excellent presentation, sir. Mr. Sushil Dalmiaji is here. We are blessed with his presence. He is a luminaire under the law, and his merely presence here is something extraordinary, not only for me, but for Taxmann also. Excellent presentation, sir, and the questions have been answered brilliantly. Hats off to the speaker, sir. Sir, I am very grateful for your kind word, and you are such a humble personality. The world knows this fact, sir. Complementary AMC services on purchase of appliances, valuation and taxability. You see, there is nothing complementary given. It is part of the sales consideration. When the company supplies the goods, they consider this AMC charges within that sales price, and since sale price is already held taxable, therefore there is no question of further taxability. Anil Rizwani ji, cement companies normally allow discounts without GST, but the dealers sell the cement after deducting these discounts. What will be the value of supply for dealers? Anil ji, I know what question you are asking. You are saying that cement companies, since the item is taxable at the rate of 28%, and they normally offer discounts at the close of the year or close of the quarter, and they allow such discounts randomly without having any background or pre-agreement, etc. Therefore, they do not reverse their output tax liability, and they normally issue financial credit notes. And your question is whether in the hands of the dealers, ITC reverse would be taking place or not. Answer is yes. The dealer should reverse their input tax credit irrespective of the fact what dealer has done, the principal company has done or not. Many thanks to Taxmann for bringing such experienced faculties like Virender Chauhan for giving extremely useful deliberation. Once again, I appreciate your modesty, Mr. Sushil Dalmia ji. Vinay Pandey ji is asking a question, sir. I am asking what will be value of the supply to the client if reels are being made by influencers for the company and they are receiving freebies for that. Vinay ji, if I correctly understand your question, you are saying what will be the value of supply to the client if reels are being made by the influencers. You see, influencers are making the reels, no doubt, for the company, but there is an agreement between the company and the influencers that the dressage, etc., would be provided by the company, or any other accessory would be provided by the company, like I talked about mold and dyes, etc. So if it is the obligation of the company, then influencers pricing will not be impacted. Therefore, whatever value the influencers are charging from the company, that is correct. Sunil Sethji, Sunil Nathji, is GST applicable on diesel price when supplied with vehicle hire charges? Oh my God. You see, diesel is outside the purview of GST. So I don't know what kind of transaction you are talking about. Vehicle, either you can hire with petrol or diesel. So if it is inclusive transaction, it would be taxable. But if you are hiring vehicle separately and purchasing diesel separately, then diesel is not liable. But this seems to be a hypothetical situation. Vinay is asking, let me clarify the question which I had asked regarding the 90% discount. The supplier is supplying the goods to its customer at 90% or 100% discount. What will be the impact on output tax and ITC reversed? My dear Vinay, if 90% or 100% discount is given, it is an aggressive discount and it may not be allowed by the tax department at any cost. So you can, if you are not still satisfied, you can find my communication from the PPT which would be supplied to you by Taxmann, and you can come back anytime to me and you can clarify your further doubts either on mobile or through mail. And Vinay Pandey has extended thanks to me. I'm really grateful for all the participants for giving me such a patient hearing and opportunity me to be a enlightened person like you. And I have really become taller while having all the interactions with you all. Thank you very much. Thank you, Taxmann.